Welcome back to another episode of Not Financial Advice. I'll ask you to like the video and subscribe to the channel because today we're going to be taking a look at Coinbase and their $140 stock. And we're going to try and get an idea of what Coinbase stock is worth on a per share basis. So let's just jump right into it. We can see here it's currently trading for $140. It looked like it IPO'd back in about 2021. Something I've learned is never buy an IPO within the first 6 months or so. They tend to go down more often than not. That was definitely a very hot time in the market when Coinbase IPO'd. But just looking at a trend line here, we might have reasons to believe the stock is undervalued. And so let's get rid of all this stuff and just see if we can look at the max drawdown and sort of the trajectory some of this stuff is taking. So that's cool. It's up 3% in the first 10 minutes of trading this morning. Let's look over the last 5 years, which will be the extent of the life of this publicly traded stock. Down 60% from all-time highs. But if we look at its max drawdown at a given point, it is about 80%. And then going back to that low point, the stock has then risen about 106%. And that's been over the last 18 months or so. And so the stock is up over 100% since bottoming out. This definitely looks like a very bullish chart. Even if we go to the 1 year basis, up 228% in a year, or 316% year to date. That's a lot. So, getting into this, we're going to take a look at my holdings on Coinbase. Like the video, subscribe to the channel. What we can see here is I own just about 10 shares of Coinbase. I'm up $625, which is 72% based on where my average buy-ins were. So I'm up 72% for $625 in profit. So let's get into what this stock might be worth on a per share basis. So as always, we're over here at Qualtrum. It's a suite of software that I pay for, but not one that I'm affiliated with. So I'll leave a link for Qualtrum in the description below. But taking a look at this company, let's take a look at some metrics that matter and see what we can learn together. So getting into this, this is going to be a large cap stock. It's showing that it has a pretty high free cash flow yield, forward PE of 60, which may or may not be a lot. Their cash and debt position is pretty respectable. I'm going to use the figures from down below. I believe they're the same. Sometimes this has a little bit of a lag to it, but they've got more cash than debt. So obviously that's a positive sign. So let's get right into it. Taking a look at revenue on this company, what we can see is that from 2019 to 2022, the company is up revenue wise. It's something like 125% a year. Now, just a word of warning here. It's been recommended by better investors than me, to wait until you have at least 5 years of growing revenue and growing free cash flow. And that may be what some people say. Other people say, wait for at least a year and a half of consistent free cash flow. And that's not actually what we have here, but we can see the revenue growth. Again, this is a stock that I own. So the revenue growth from 19 to 22 is something like 125% a year. I don't think it's going to continue at that rate forever. But let's just keep in mind that it's growing around 125% a year. We're going to be shaving off a lot of that growth when we get to the back half of this video, where we're looking at the fair value estimate for Coinbase stock. So moving right along, let's take a look at the free cash flow. And so what we can see here is it's been positive at times, it's been negative at times. The average that I got is just a little bit under 2 billion a year in free cash flow, averaging out for the times when they were free cash flow negative. And so a little bit more in Coinbase. Of course, it's a brokerage that trades in crypto assets. And so I think this would be a good time to sort of expand on the thesis for owning this. So it's been said when everyone's mining for gold, sell shovels. Something that I think is a better metaphor is don't gamble, own the casino. And at the same time, some people would say that crypto is a scam. It's monopoly money. It's not, it's going to go away. Um, so that would be, the bear case. There was a cool thing in history. There was a booming market in tulip futures, yeah, the flower, back in, I think, the Netherlands in the 1600s. So aristocrats were super into tulips. They were imported. It was a sign of status, and um, people would buy tulips or buy contracts to buy special rare breeds of tulips in the future. And so it just went crazy. It went insane, way above the intrinsic value of something that is not tangible. And so there was a huge market for tulips in Northern Europe in the 1600s. It went up like that, and then it went down like that forever, and it was gone. And so that would be a bear case for crypto. The bull case for crypto would be that some very smart people and some very rich people and some very powerful organizations, be them governments or places like it might be BlackRock, or it might be Fidelity, it might be other organizations, are buying crypto assets and holding crypto assets on their balance sheet. And so at the end of the day, the question is, crypto is a new asset class. It's a 15-year-old asset class. And so how much exposure should you have to something like that? I don't know, maybe like 1%, which I think is where I'm at. Maybe 3%, but not a whole lot more than that. And I think if crypto is going to be as revolutionary as people say, and it's going to 100x, then just having a little bit of that exposure. For me, for my preferences, I'm not exposed to the coins themselves, but again, I'm going to own that casino or own those shovels. So I'll ask you to like the video and subscribe to the channel, and we'll keep moving forward here. Let's take a look at some other things. So cash and debt. Um, they have more cash than they have debt. So this is going to be a check mark on cash and debt position. Free cash flow is going to be, I'm going to give it a check mark as well. Revenue, I'm also giving a check mark. So, taking a look at return on capital employed, there has certainly been times when they've been able to get a strong return on capital employed. But then there's also been times that it's been negative. So, it's probably sitting somewhere around 10%. That'll just be a neutral, sort of a dash mark. But we don't have the most data to go off of here. And then they are raising shares, or issuing shares rather, which we don't like to see, by 10% over the last 10 years, 2 years rather, according to Qualtrim. So that'll be an X mark on this stock. So I think we've covered it all pretty well. Um, we're going to go over here and just sort of take a look at the projected growth rates of crypto as a industry, I suppose. And so some different sources are saying 12.5%, which is 10% of that 125% growth that they've had on average for the last 4 years. So this is one that I think is going to be a little bit tricky to value, but we're just seeing different people saying growth, in the next 5, 7, 10 years of around 12, 11%, 14%. And so we're going to sort of temper that growth of 125% a year, um, while also realizing that this stock is not very old. Um, this is sort of uncharted waters here, and some other people are showing this overall category to grow at only 10% of the size of the growth rate of the company itself. So, $140 stock. Let's see if we can get an idea of the fair value on the stock. I'll ask you to like the video and subscribe to the channel, and we're going to get right into it. So, using all the metrics and figures that we saw from Qualtrim, and a little bit of my own tabulations here, we've got an average free cash flow of $1.6 billion a year over the last 4 years, $5.3 billion in cash, $3.4 billion in debt, 222 million shares outstanding. Now, what I've done here is I went as conservative as possible, and I projected the growth rate not based on what I was seeing with the stock, but just based on projections for this overall category. So I put in a growth rate of, I think this is very, very low, but I put in a growth rate of 12.5%, 7%, and 3%. So being 1% of your portfolio, if this goes to zero, that has to be fine. And if at 100x, we'd love that. Anywhere in between would be satisfactory. So I think a standard discount rate with these conservative projections is reasonable. $140 stock value, $186. So we're going to look at two different scenarios here to see what we can come up with. I think that based on the growth that I was seeing from that company, it was growing at something like 125% a year. I'm just going to put in 30, 15, and 3 and see what we come up with here. I think this might be a little bit more realistic, but because this is a little bit weird. Let's put in a higher required rate of return at 15% and see what we come up with for a value. So in that case, we see a value of $240. So previously, a pretty demanding valuation showed the price of this $140 stock at a fair value of 186. When we add uh, the $240 valuation with a higher required rate of return, which I think is reasonable, what we come up with as an average between the two scenarios is $213. And that's what I would say. I think this stock is worth around $213 a share. So currently trading for $140. I think it's worth $213 a share. And so I'm up on it big, like 70 plus percent. I'm going to continue to hold and I would buy at any point up until that $213 level. Like the video on the way out, make sure to subscribe to Not Financial Advice, and I will see you on the next one.